In this episode, we're talking with Terry Ryder from Hotspotting, and we're going to explore exactly what hotspotting is or what it should be, what investors need to be considering before they make decisions based on short-term predictions, and whether sometimes Terry wishes he'd called his business something different.
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
And I'm Chris Bates, mortgage broker, recently ranked number 5 in Australia out of over 18,000 brokers in the annual MPA Top 100 Mortgage Broker Awards. Before we get started, I need to let you know that nothing we say here can be taken as personal advice. We always recommend you engage the services of an appropriate and experienced professional.
Our guest this week is Terry Ryder. Terry has been a specialist researcher and writer on Australian residential property for the past 4 decades. He began his career as a property journalist, and over the years he's contributed to a number of major publications, as well as publishing 4 books on the real estate industry. And in 2006, he created the very well-known website hotspotting.com.au, which provides reports and subscription services to property investors advising the best places to buy. Today, we're delighted to have Terry along to talk about how the short-term activity of hotspotting sits well in the context of his long-term experience of the property market. Thank you so much for joining us today, Terry. This has been a long-term time in the making. I've been trying to get you on the podcast for, I know, over a year. So thank you so much for joining us.
Okay, well, I'm sorry it's taken that long. I can't imagine why I've been reluctant.
We can't either.
Terry, I mean, I've seen your names around the traps for a long time. I remember always back in maybe 2012, 13, was at a home buyer expo, and I mean, you were doing hotspotting before every buyer's agent in the country was doing hotspotting. I mean, is that some of the reasons why you don't like the name? Is that it's become a plethora of buyer's agents entering the market in recent years that are trying to pick the next growth market?
Yeah, well, there's a couple of separate issues there, and certainly I do see there's an enormous problem for the industry of so many people calling themselves a buyer's agent and who don't really have a lot to offer to property investors. It seems the only qualification you need to call yourself one of those is a pulse, and then you can hang up your shingle and go for it. But the problem I have with the name hotspotting, and yes, sometimes I do wish that I'd called it something different, is that there is a connotation that media puts on hotspot and hotspotting. That's not what we intended. It's not the way that we approach it. Sometimes a hotspot is defined as a short-term flash in the pan, sugar hit kind of a location like a mining town. That's certainly not what we would ever advocate to property investors. We've never recommended mining towns or locations with just one major plank to their economy. One of our central planks is economic diversity, strength and diversity in the local economy. We think that's absolutely paramount. And we do take a long-term view with what we recommend. So if we put out a top 5 or top 10 hotspots report, we're recommending places that we think are going to outperform over the longer term. And that's what we mean by hotspot, a location that will outperform market norms over time.
Yeah, because it does. And that's definitely where my brain goes, if I'm honest. I hear the name that, and it straight away, it makes me feel like, just got to go there to capture some short returns and make money while the market's hot. And then I'm going to bail on that market. And, like you're just basically saying there, that's really hard in resi property to pick the hot spot, get in before the party started and then leave before the party is finished and pay capital gains tax and pay buy and sell costs and potentially, buy a better property that outperforms the growth in that market. Do you find that that's something you're constantly having to recorrect with people, that's just not what your philosophy is? Or
yeah, well, I think we're constantly trying to correct misperceptions and misconceptions amongst property investors. Sadly, I think the average investor is a bit of a herd animal, and that far too many people pile into markets because they read there's a boom happening rather than having a clear strategy based on good advice and good information and pursue that strategy regardless of what the media is talking about or what the next election result might be or what the next Reserve Bank decision might be. People with a strategy and thinking clearly about property investment will be pursuing that strategy regardless of all the white noise in the media and just getting on with what they know works, taking a long-term view. And that's certainly what we advocate.
So let's go into your mission is really to identify areas that you believe will outperform. And you're saying over the long term, it's quite difficult to predict, I guess, anything in the property market over the long term. So what sort of time frame are we talking here? And when you say outperform, compared to what?
Or compared to what you might call industry norms. In 2024, according to the usual suspects like CoreLogic and PropTrack and others, the average result in Australia for houses last year was about 5%, 5 or 6% rise in the national median price, which we tend to think is irrelevant because we do believe that real estate markets are local in nature and that the national averages that are, the media is right now full of stories about property prices are falling. Well, they're actually not. The national average dropped 0.1% in the month of December, according to CoreLogic, mainly because the two biggest cities have had declines. But in most market jurisdictions across the country, the vast majority of them prices continue to rise. But to go back to your original question, locations that perform national averages, which last year was around about 5%, and pretty much everywhere that we recommended, say 12 months ago, has done better than that, but always keeping in mind that we're not recommending locations for their growth in the next 12 months specifically. That's nice if they do perform in the first 12 months because that gives investors some early equity that they can do something with to perhaps leverage to buy more properties. But
it makes you feel good too, doesn't it? I mean, you buy something, you incur all the costs of buying it, you've all that mental energy that's gone into deciding on that particular asset and going ahead and buying it, and then you want to see it go up in value because that makes us all feel good. We're not so silly.
It does give you reassurance, and I mean, right now I'm grappling within my own mind with a property in my portfolio, which is in regional Victoria, which has been one of the underachievers in the last couple of years for some pretty clear reasons, some of which are to do with the quite appalling state government in that particular part of Australia. But the location that's in my portfolio that's in regional Victoria had some great growth 2 or 3 years ago, but in the last couple of years it's been flatlining or coming back a bit. And I have to constantly remind myself, look, I bought this property for the long term. I believe this location will perform long term. And I need not be too concerned that in the last couple of years it hasn't done so well. But all markets do that. I mean, no matter what location we call up on our portal on the Hotspotting website, looking at the graph over the last 5 or 6 years, there'll be a period of growth and there'll be perhaps a period of flatlining and they'll start to grow again. The ones that are doing that, we call them the second wind markets. So these are the markets that we're particularly advocating to people at the moment, whereas far too many investors have been piling into frenzied markets at the peak of their boom, such as in Western Australia and some parts of regional Queensland. We're advocating markets that actually have been not showing a lot of growth in the last 1 to 2 years, but have in the past, and we believe are ready to go again. They've had a sprint in the past, they've stopped, caught their breath, now they're ready to go again. We call them second wind markets.
It's like value investing.
Sorry?
Like value investing in the stock market.
Well, that's right, perhaps. But really, buying at the right time in the cycle. We do believe that real estate is local in nature. We don't have a national property market. We saw it last year, a typical year in which we had some markets had boom time growth, some had moderate growth, some flatline, and there were a few that actually dropped in value in 2024. That's normal. But those who want to buy now, I would suggest rejecting the idea of piling into Perth or, say, a frenzied regional Queensland market like Rockhampton or Townsville, and looking at places that have similar ability to show growth over time, but are at a different point in the cycle.
It's hard though, right, Terry? You got to go against the herd, which is kind of what you mentioned before. And think about a lot of people got into Brisbane. Brisbane's going to boom. Brisbane's going to boom, and then we've all got a mate who's bought a property out there, has done nothing, and then all of a sudden it takes off, right? And The ones who made the most money is the ones who got in really early. And the same thing in Perth. Perth's going to go up. It's going to go up, and it took years, and it's unexpected. Even though interest rates are going through the roof. Perth market's taking off, right? So it's where the best growth is, right, and the lowest risk to get that returns. It's just sometimes you might be a bit too early, and is that the fear you've got to get around? Is that rather than looking for short-term returns, you're looking for a great long-term investment, you're reframing your mind?
Definitely, you definitely do need to take that long-term view. But that herd mentality instinct that drives so many people, I think it's the wrong one. I don't think anyone's ever truly succeeded with real estate investment by following the herd. Perhaps you can succeed by leading the herd, but I think most people succeed by detaching from the herd and running in the opposite direction. And if you look at people around the world who have been truly successful with all forms of investment, that's pretty much what they do in simple terms. And
well, it's about choosing a good asset and then consistency, just holding out. Like you were talking about, even in your regional Victoria example, it's like having the patience and the temperament in a way to be able to resist that urge to tinker, really. Now
it does take character to do that, because people like the comfort of the herd, and that's why so many people take that course. But I think it's the wrong one to take. I often find myself quoting Warren Buffett, one of the 5 or 6 richest people on the planet. He's essentially not about property investment. He's more about share market investment. But he said some very wise things that are worth keeping in mind for property investment. And one of them was, my favorite holding period is forever. And he also said that he doesn't care if the stock market closes and stay closes for 5 years, because he never intends to sell. He buys good assets and he intends to keep them for the duration.
I'm reading a book called The Psychology of Money at the moment, and there's I'm about 20% the way through it. It's fantastic if anyone wants to read it. And he does talk about Warren Buffett, a number of references in there, and one of the interesting ones was that at the time of writing that book, I think he was 89, and apparently some huge percentage of his wealth had actually been accumulated in the last 10 years of his life up to that point. And that's because of the nature of compounding, and because he's been investing apparently since the age of 10, and because he chooses his assets and doesn't sell. So he's not a trader, he's a true investor. And so that, even just the very, very fact, and we're talking something at that point of time, he was worth $80 billion. I think, look, someone can probably blow holes in my numbers here, because I've forgotten the exact numbers, but it was something like 90% of that 80 billion he was worth was literally had grown in the preceding 10 years. And so that's really what you're talking about here. It's that patience game.
It does show the value of taking that long-term view. And I'm grappling with that in conversations with my partner at the moment, because like many investors, because interest rates have risen so much, properties in the portfolio that previously paid their own way are actually not paying their own way at the moment, and are having to tip in a little bit of money from my own income to support them through this period. And she's a little bit twitchy about that, but I'm taking the long-term view and pointing out that if this property grows even 4 or 5% in value in the next 12 months, it's more than covering any of that extra expense. And given that we choose good locations, they're far more likely to grow by considerably more than that, and we're well ahead in the long term.
I mean, the irony with Warren Buffett is that he's been living in the same house for 60 years as well.
Yeah. He probably doesn't have a fancy wardrobe.
He eats the same food every day, and that's McDonald's, but drives an old car. So holding forever is great if you want to give it away or to the giving pledge. And but it's not in reality of most Australians to hold forever. There's always going to be a point where you're going to have to cash your chip, then try to enjoy your life. I mean, the other thing there, I mean, you did sort of, almost thought you were talking about your children there, Terry, when you were talking about supporting your properties through this difficult period. But how does Terry Ryder think about your portfolio? If you had to sort of cash in all your chips and go again, and Would you buy, 10 properties or 5 properties if you had the same amount of money? Would you go established versus new? Would you go apartments or houses? Would you just go pure long-term holds, or will you go for like renovators? Like, how do you design your property? If you just as your money, it's not what other people, if you had to start again, what would you do?
Look, well, I'd certainly do it differently, and I think you're going to ask me a question about dumbos at some point in the conversation,
We
and
are.
this kind of speaks to that. Look, I would do it differently because I didn't understand the value of acquiring good assets and just keeping them for the long term when I was starting out. When I was starting out, it was in the 1980s, and it wasn't actually common for people to actually. It wasn't talked about the concept of ordinary Australians buying investment properties, building a property portfolio. That was quite an unusual thing then. I think an intelligent person approaching property investment will take a long-term view, will take the attitude of buying good assets and keeping them. There's no such thing as never, but my attitude and one of my mantras is never ever sell, although there's no such thing as never in property investment, of course. But also trying different styles of investment that make sense to you. I mean, I'm very comfortable with passive investment. I don't do much value adding, although I do have properties in my portfolio which were bought with a view to future value adding, like doing a small subdivision because the land size is above average. But I'm not a renovator, for example, because I don't have that mindset or those skills. So I know I'm smart enough to know what I don't know and that what I should stick clear of. So to a certain degree, a sensible strategy depends on the individual, their circumstances, their age, their skills, their risk profile. I know what I'm not good at, so I stick to what I am good at.
Now, your methodology for identifying locations to invest in, my understanding is that it's sort of largely based on sales activity. So I'm hoping that you can sort of explain the thinking behind that. And I guess it's not as simple as just monitoring sales volume activity.
No, really, that monitoring of sales activity only really applies to one of our products, and it's a product that kind of takes a short-term view. All our other products, our top 5 hotspots reports, our top 10 hotspots, they all take a long-term view, and it's not really based on sales activity. So the one that is the price predict index, because what I've observed through my research over more than 4 decades now is that sales activity can be a good forward indicator of what will happen with prices in the short term. So if sales activity is rising quarter by quarter, prices will follow that trend in most cases. And if sales activity is falling, as we're now observing it happening in a market like Perth, then we're going to see price growth start to slow down and stop, and maybe prices fall. That's the price predict index, taking a short-term view. But the essence of what we do is taking a long-term view, and it's not about sales activity. It's about the underlying economy. It's about infrastructure spending. It's about jobs creation. It's about population and demographics and all of those things.
And when you say a long-term view, what can you put a time on that? Is it 5, 10?
5 to 10 years would be a typical long-term view, but maybe longer, depending on the age that you're starting out. If you're in your 20s or early 30s starting out, then a long-term view might be looking ahead to when you might retire, in your 60s or whenever you choose. So it very much, again, depends on the individual. But at least 5 to 10 years when you acquire an asset, I think you should be thinking in terms of at least that time frame to see it really blossom and show you some really good growth. In properties in my portfolio have really shown extraordinary growth in the last, say, 3, 4, 5 years, because we've had that period where there has been, in good locations, substantial growth, and a place that I bought, say, 4 years ago is now worth more than twice as much as I paid for it. It's not always going to be like that, and that location isn't always going to produce that level of growth. But over a 10-year period, you should see that kind of what I call blossoming of the property and the potential that it had when you bought it.
Is that a place over in the West Coast? Is that what did you buy there?
In Western Australia, no. Actually, the properties I was referring to there were in places like Adelaide, and
Okay.
and some parts of regional Queensland.
Okay. Terry, 4 decades of research, I think you mentioned there. I've had this discussion, many a times around just locations and then, properties within a location, A, B, C, D, a poor street, a south versus the north block, a weird block versus a good block, the better part of the suburb versus the worst part of the suburb. Do you think it really matters if you're buying long term or the mean just growth? You just buy any property in any suburb if you're going long term, if you're getting it at a fair value, or should you really try to focus on a better quality asset in terms of, what's more desirable within that suburb to and compared to other parts?
Yeah, well, firstly, we tend not to think in terms of suburbs. I know media loves, the best 10 suburbs to buy. We don't think like that because we don't believe that this suburb is going to perform better than the 6 or 7 or 8 suburbs that surround it necessarily. We tend to take up more like a local government area view because the factors that are driving that municipality is a good place to buy.
Yeah, fair enough.
It might be new motorway, it might be the creation of a major new hospital. There's not just going to be one suburb that benefits from those things. All the suburbs in the area will benefit. So we tend to focus on those broader areas as growth markets, and then it comes down to finding a property within that broad area that has good locational features, and it doesn't have to be the best street. We do talk about what is sometimes referred to as the sweet spot within an area. And there can be many sweet spots, but it's generally defined as being within, say, walking distance of schools, shops, and public transport as the basics. And maybe also green space is another factor that I really like to see in a location that might do well. You don't want to be too close to the train station because it can be noisy. You don't want to be across the road from the local primary school, but if you're within, say, reasonable walking distance of those locations, public transport, schools, shopping centre, then you've got a sweet spot. Then you will always get tenants wanting to rent in places with those features, and you will always find buyers for a property that has those features.
So you're sort of identifying the features as still being locational features, though, rather than necessarily property specific. So, in some areas, for example, there'd be different building types, or there'd be different floor plans, or there'd be 2 stories versus a single story. There'd be sort of set back on the block versus set forward on the block. There'd be lots of nuances there. Is that something that you spend time analysing, or it's really does come back to where it is located for you?
I honestly believe location is the key thing. We don't spend a lot of time trying to analyse whether a 2-story property shows better capital growth than a single-story property. It's really about location. A wonderful looking quality property in a really bad location isn't going to show you capital growth necessarily.
100%.
Our big emphasis is definitely on location as the key feature. And then, it's up to the individual as to their preferences in terms of property types. There has been a long-standing belief that houses on land show better capital growth than attached dwellings. We think that one of the big changes we're seeing in real estate across Australia in the last 1 to 2 years and into the future is that paradigm is changing very, very much. More and more cohorts are opting for units, townhouses, apartments for lifestyle reasons, for affordability reasons, but also for safety. There's so much media about crime on the streets. People feel safer on the 10th floor of an apartment building, perhaps with security features. So there's lots of reasons why people are opting to buy units rather than houses on land. And in the Greater Sydney area now, more than half of all sales are attached dwellings rather than houses on individual blocks of land. And that change is changing the paradigm, which says that houses outperform units on capital growth. That's changing quite dramatically. Not everywhere, but in many places it is. So that's something I think for investors to think about. And it's a good thing because investors are struggling to afford a house in an area they like, might be able to find an attached dwelling more affordable. And they'll probably also find the rental return better. So there are a number of reasons why that's an excellent trend for people to follow.
I'm on a personal mission to help more people make better property decisions, and you can find out all about what I'm working on at veronicamorgan.com.au. There you will find resources for first home buyers, details about my buyer's agent mentoring program, information about my newest project, Preferential, proactive property management in Sydney, or if you're looking to buy your dream home or investment property in Sydney's inner west, eastern suburbs or lower North Shore, you can connect with my team at Good Deeds Property Buyers. And if you'd like a 30% discount plus free postage for my book Auction Ready, How to Buy Property at Auction Even Though You're Scared Shitless, and yes, I'm a potty mouth, use the code ELEPHANT at the checkout.
If you're looking to buy your first home, thinking of upgrading to a new home, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and importantly get the finance right. Please reach out to myself and the team at flinggroup.au.
I guess, people are going for the apartments and the detached dwellings. I mean, if houses were dollar for dollar, and, they could borrow that amount to get into houses, I think you'd probably still find that people would naturally want the bit of grass versus the balcony and the shed courtyard. I mean, there is definitely a subset of the community that would prefer to be around people, but all the issues with strata. And I mean, the issue you got with apartments, if success apartment ends up leading to its downfall, to be honest, because you can't really replicate houses, but you can definitely replicate apartments. So if apartments go up in price, that then creates a little bit of a building boom, and then that, increases stock levels and, and increases, options. Do you, I mean, that's kind of constantly been the problem with apartments, say in capital cities like, Brisbane and Melbourne, right? More demand, more supply, more demand, more supply. So, and it constantly keeps a lid on prices. Sydney's a bit different because they haven't got the ability to build as cheaply, but I mean, that's my concerns with buying apartments.
Well, I think we have the opposite problem at the moment. We're not building nearly enough apartments or any types of dwellings, and the reason is because the cost structures are so ridiculously high that developers are just saying, no, it doesn't stack up. We're not doing it. The market won't pay the price we need to charge. And so we actually have the opposite problem. The Gold Coast, which has had a history of oversupply, which has kept suppressed capital growth, now has the exact opposite problem. We've now seen for the first time in my experience, we're seeing exceptional capital growth in units in Surfers Paradise, for example. Now, I don't see that paradigm changing anytime soon. There's no solutions being put forward by any government in Australia to the shortage, to the construction cost factor, the shortage of tradespeople, all of those things that are feeding into this problem. So, but I generally,
at some point though, the price goes up to a point where that feasibility does make sense, right? So the moment the builder's like, well, I'll land bank it, the development approval process is quite relaxed up there. At some point, the affordability for people gets stretched, the growth stops, and if some people go out and say, I can buy new for the same price at 800 grand, the developer says I can make money on that, and they start building, and you'll absolutely see another building, because developers go where they can make money, and so. I guess at some point you can definitely capture the upside, but at some point the tables turn and more supply gets built, unless you buy an apartment in an area where they can't build more apartments. I mean, that's, due to NIMBYism or due to topography or, just due to location. I mean, a place like Gold Coast, you'd argue though that at some point there's no real cap on supply, right? Like in a lot of areas.
No, I certainly, we don't really advocate buying in sort of mega high-rise buildings anyway. For apartments, I'd much rather go down the boutique route, small blocks, townhouses, or blocks of 6 or 8, something that's got some individual quality about it. Yes, and definitely in areas where, according to the zonings, they can't build a lot of high-rise, like Noosa Shire, for example, that they're very, very strict on their height restrictions, and apartments there have shown incredible capital growth over time.
Yeah.
It's interesting though, Terry, because I never really thought about this before, but obviously your mission is to identify locations, and I guess some of the locations that you'd be looking at would be apartment centric. Because in the sense, and I guess I'm going to a question here. I'm guessing that some locations, it all depends on what property is available, right? You're doing your numbers, you're doing your assessment analysis based on fundamentals as you've spoken to. Are you seeing that there are some areas coming up in your research as recommended for long-term growth that are offering a lot more in the apartment stock versus the housing stock. Is that something you're starting to see?
Not particularly at the moment, because we're not seeing apartment stock being built because it's incredibly expensive to build a house on a block of land at the moment. But the most expensive product to build at the moment is an apartment in a sort of medium rise or high rise building. And I've had a number of conversations with developers who have typically done that sort of product, and they say we're just not building them because it is so expensive, and we'd have to charge $700,000 for a 1-bedroom apartment, $1 million for a 2-bedroom apartment. The only market that makes any sense to developers of apartments at the moment is the luxury market, the luxury downsizer market, where they can charge $1 million to $2 million or more for a really good quality apartment. There is a market that will pay for that, but the mainstream market won't pay the prices that developers would have to charge to make a profit because of the cost structures at the moment, which are largely caused by overlays from council and state governments. Also, shortages of tradespeople and all the other problems that are happening in the building industry. I mean, in 2024, home building companies went broke at the rate of 9 per day in Australia.
God.
Over 3,000 construction companies were lost. Just adding to the shortage of everything in real estate, which is exacerbating the problems we have, which is shortages of all the things that are important, which means there's going to continue to be upward pressure on rents and prices as a general statement.
You've been going now in the hotspotting arena for nearly 20 years. Have you tracked actual performance of the areas which you've recommended over that time versus the predictions or the recommendations that you've made? And tell us some of the learnings that you've had from that. I'm presuming you have done that, so it's a presumptive question here. Assuming you have done that, what sort of learnings have you accumulated over that time period?
Yes, we do it. We quite often do, and quite often when we come to market a report, we often go back and look at what we recommended in the same report, like our National Top 10 Best Buys report a year ago or 2 years ago, or sometimes 4 or 5 years ago. And it's really interesting to look at that and see what markets have done. Generally, that they do outperform, not always, because I don't think anybody gets it absolutely right all the time. But for example, say 3 years ago, our Best Buys report, we were starting to talk about some locations in Perth, and people were reacting, saying, why are you recommending Perth? Perth's prices have fallen for 10 years. And we're saying, well, because we think we're always looking for change. Things are always changing in real estate. That's what we're looking for, something changing in the dynamic of a location that's going to mean the prices which haven't performed are going to start to. And that certainly happened with Perth 3 years ago. Also around about that time, 3 to 4 years ago, we started including the Sunshine Coast at the top of our list nationally, and people had the same reaction because that market had shown no capital growth for 10 years. But we could see that because of the massive infrastructure spend that was happening, there was going to be a game changer for that market, and it reacted with property values as a general statement doubling in the space of 2 or 3 years. And it will continue to show growth because that's an ongoing process now with that particular location. So yes, we do go back and look at that, and sometimes we celebrate that we identified something, because we're always looking to identify a location before it becomes hot. That's the whole thing. There's no point
So
in time.
it's pre-hot spotting.
Well, that's right. And identifying the future hotspots. That's what we're about doing. We've been an advocate of Adelaide. Adelaide's now very fashionable, but for so long, people always rejected our recommendations about Adelaide because they said it's a no-growth city, no population growth, no economic growth. And some people still think that because old attitudes die hard. But these days, South Australia is one of the leading economies in the country. And Adelaide's become a growth city with fantastic capital growth in its property market, no longer the affordable place that it was, and no longer has those high rental returns that it has because they've had so much price growth recently. Don't always get it right. Last year, we thought Melbourne would do better than it did, and it's obviously underperformed again, and we're a little bit annoyed with Melbourne, and we're choosing to blame the state government for that. But we do think that Melbourne's time will come. It can't go on being cheaper than half the other capital cities in the country forever. It's got a strong economy. It's got very significant population growth and a very big infrastructure spend, which will generate in time.
Yeah.
Terry, you've got a lot of reports on your website, which is I'll be doing the same thing if I were you. But which is the one that you? I mean, it might be your little IP, which one's best performing, but where do the people click the most? Like, because if someone just comes along you, do they go for the cheapies? Do they go for the national apartment hotspots? Like, what's your best selling report? Like, because you've got a bunch on there. Is there one that just goes a lot more than others?
Well, the best buyers report is consistently one of our best 2 or 3. The price predictor index is also very popular. Sometimes the popularity of reports perhaps relate to publicity. That price predictor index, which we publish quarterly, always gets quite a lot of media attention. And so that may be a reason why a lot of people want to buy that report. But it's that one and the best buys that are most popular. You mentioned the cheapies. Yes, those are popular reports as well because so many people are looking for affordability. It's amazing how many people want to be a property investor, but they can't afford to spend more than $400,000. Well, that's a problem. It's not a problem without solutions. There are places that have growth credentials where you can buy and that sort of price level, but it's becoming increasingly hard. But yes, affordability is the key word for so many people are out there wanting to be property investors and home buyers.
What do you think about these data-driven buyers agencies that are getting a lot of clicks online through social media advertising and getting quite a lot of success with being property buyers agents with data-driven property buying? What's your thoughts on those type of models?
Well, I mean, I think real estate investment should be data-driven, definitely. But having said that, I mean, there are a lot of people claiming to be buyers agents and claiming to be data-driven that aren't necessarily so. And it's really important for real estate consumers to understand how to determine the difference between the genuine ones, have quality advice to offer, and are worth paying a fee to, and the ones that aren't. And there's just so many. Somehow the idea has been sold that being a buyer's agent is a really easy way to make lots of money in your spare time, and it's not true. And so many people out there pretending to be that shouldn't really be operating. And they probably, most of them won't last because it's a lot of hard work and it takes expertise and experience and all the things that you know to be true. But it is cluttering up the industry at the moment.
So someone buys your report, Terry, they get these 5 top suburbs. What happens then? Do you suggest them go to a buyer's agent? Do you suggest a DIY it? I mean, do you even go there at all? Or you just say these are the areas you should consider?
Well, we established a panel of partners because our modus operandi, our stock and trade is selling reports to help people find the best places to buy. But then people come back to us and say, okay, now I think I know where I want to buy, but I need a mortgage broker, or I need a buyer's agent, or I need an advisor of some sort. Can you help us with that? Can you recommend someone? So we've created a panel of people that we've known a long time and are happy to recommend. We also have strategy sessions on offer. People can buy some time with me or with Tim Graham, my general manager, and just talk about what they want to achieve, and we can help them sort of. I think the word I hear most often is overwhelm. A lot of people are overwhelmed, partly by the size of the country. Where in this vast country do I buy? I don't know how to decide that. And it's surprising how a relatively short conversation can help them get over that sense of overwhelm and give them some tools to make decisions. We do ongoing mentoring. So in those processes, we talk about, should you be doing this yourself, or should you be using a good quality buyer's agent? And I often tell people, and it's quite true, that I always use a buyer's agent when I buy. And I don't, I like to think that I know quite a lot about real estate markets and where to buy, but I've got a very busy life, and a buyer's agent can save me a lot of time. But also, I like another set of eyes on what I'm doing, because I'm not foolish enough to think that I know everything, and I like to have somebody whose opinion I value, giving me some feedback on what I'm thinking of doing, where I'm thinking of buying. And quite often, I do end up buying somewhere that I hadn't originally thought was top of my list, because we've had that conversation with a seasoned professional who's. The thing I like about a good buyer's agent, they're on the ground at the coalface. I like talking to people at the coalface of the industry. The data is useful, but quite often it lags. And there's people at the coalface of the industry, like selling agent, buyers agents, valuers, who know what's going on today in a market. Those are people are worth talking to and worth having on your team and worth paying a fee for. I think people who think they can penny pinch their way to success in property investment are indulging in false economy. I think people should be willing to invest in advice and should be willing to invest in good information to make sure that the choices they make, the properties they buy, are the right ones.
It's interesting. I was going to ask you, but you sort of answered the question before I got to ask you, was do you engage a buyer's agent who is a local specialist who can then pick up where your data has pointed you and then actually add nuance and add that expertise? Or do you get another, like a broad, a buyer's agent will buy anywhere? Because the problem with that, in a way, that those buyer's agents that buy anywhere, they're often the ones that claim to be data driven. And then I always wonder about, well, the data's the easy bit in a way. Like it's what you do with the data. It's how you interpret that data. It's what you take from that data and how you apply it, right? Because there's there's so many, there's so much data out there, and I think that's where people often get overwhelmed, because there's all these sort of people. There's players out there offering their secret sauce to how to identify a location to buy in. And that's, I guess, why we wanted to interview you. You've been around a long time. You've been doing this a long time. This isn't a flash in the pan for you. This is something that you've been honing, I would imagine, over these decades that you've been doing this, as opposed to trying to come up with something that's sexy, that's using short-term metrics to justify it as well. Yeah. So when you're working with those buyers agents, what are some of the things that you said, you don't know everything. You've got the data. It's taking you a certain way. What are some of the insights that perhaps you could share with us that by working as a team you've gained, as opposed to if you did the whole thing yourself?
Sometimes the research might be directing me towards a certain location, and a buyer's agent who is actually active in that market will say, look, what we're finding is that, yes, there is fantastic growth happening in this market, a lot of demand, but it's so competitive that it's really hard to buy well, and it's almost impossible to buy with due diligence. If you
that sounds like WA, really. Full stop.
But also recently, some locations in regional Queensland, like Rockhampton and Townsville,
Right.
if you put forward an offer, a contract, subject to building and pest inspection, the usual due diligence you want to do, you're going to be beaten by, because there's 15 or 20 other people wanting to buy that property, offering more than the asking price, and willing to buy without any conditions. And so a buyer's agent on the ground, active in that market, can give you that kind of feedback. And my reaction will be, okay, too hard. I'd much rather buy in a location that's less frenzied, where I can buy below the asking price, as long as the location that I know has the credentials for future long-term growth and will perform in the future. And that's my most recent purchase. That's exactly what happened. I was keen to look at some of those regional Queensland locations, but just too hot, too competitive. I ended up buying elsewhere, in a place that we do have a report on. We do know it's good, but it's a second wind market. It's actually in that pause phase, about to rise again, and that was, I think, a far more sensible purchase. Will prove to be over time.
Yeah, very interesting.
Terry, have you got a property dumbo for us? You gave us a little bit of an insight into one before. Have you got another?
A property dumbo? Well, the ones that occurred to me in answer to that question were the people who are jump into markets at the peak or past the peak, and there's so many of them. Another one where I come across quite often, particularly doing strategy sessions with people, and you sort of ask about, I want to know about your current situation because that will influence your next steps. It's amazing how many people own 3, 4, 5 properties and they're all in the one location, and they're paying land tax, but also they haven't spread their risk across multiple parts of the country. They're vulnerable to, if all their properties they've invested in so far are in Melbourne, their portfolio is going to be looking a bit sick at the moment compared to if they had a spread of properties in other parts of the country as well. But referring to my own experience, I was a dumbo in my 20s when I didn't understand the simple philosophy of buy good assets and keep them. I was thinking that I would trade my way to success. My first purchase cost me $25,000. You can imagine how long ago that was. A suburb of Ipswich in the Greater Brisbane area, probably worth 650, 700,000 now. But particularly the one that really rankles with me is the second one. I sold that one and moved closer to Brisbane where I was working. I bought a humble house, but in a very good block of land, elevated with views up the Brisbane River. I paid $52,000 for it, and today the land alone will be worth over $1 million. And every house in that street, my home and all the others, have been knocked down and replaced with mansions because the land was so valuable. Now, I would dearly love to still own that property and some of the others that I bought along the way. So my philosophy these days is never ever sell. Buy good assets and keep them. But back in the day, I was a bit of a dumbo because I didn't know then what I know now.
Well,
Do you reckon you would have been able to keep them?
yeah.
Obviously, no idea. It's there's always that philosophy, right? Buy, hold, never sell. Always want to keep my first property. But the reality is the challenges in doing that in today's is actually quite hard. Everything needs to go into the next jump.
But it's achievable. Sometimes I think, and I've spoken to many people, I've had this this brick wall where they've got such a certain level of debt, they can't get any more finance, even though they've got a performing portfolio and a pretty good income. So at some point along the way, maybe you do need to sell a couple of properties to allow you to go forward and buy more. So that's the reality that I think people will face along the way.
Yeah.
But back then it wasn't so easy. The mentality now where you can sort of release equity from a property you own and use that to buy another property, that wasn't around back in the 80s when I was starting out. The whole concept of an ordinary person on an ordinary income buying investment properties and growing a portfolio, that just wasn't talked about. It wasn't a prevalent concept in those days. So it was, if I'd been doing it that way, I would have been definitely ahead of my time, I think.
Yeah. Out of curiosity, you talk about one of your dumbos there was the amount of people that come to you having a portfolio of properties and all in the one location. So there's no diversification. What drives them after amassing, a number of properties? What drives them to then go and get some strategy advice as opposed to along the way?
Yeah. I think it's that they've got to a point where they realize that things aren't performing as well as they had hoped. I think everybody comes into property investment for the first time with a dream. And sometimes I'm going to build a portfolio, I'm going to retire early.
Yeah.
But the stats show that most people never get there. All the people own investment properties in Australia, there's only less than 1% that own 5 or more, according to the official statistics. Most own just 1, some own 2. And the question is, why is that? And I think it's because those early purchases are not wise purchases. They jump in without a proper plan, without seeking advice, without being willing to invest in advice and information, and they make bad choices. And so they end up with a few properties perhaps, but they're not moving forward the way they had hoped to. And so that's when maybe it occurs to them that they should get some advice and find out why not. And I remember doing a strategy session with a person who came to me, had owned 5 properties, and they were all in Queensland mining related towns, and they were all worth considerably less than they had paid at the peak of that frenzy back then, and was seeking solutions. There really weren't any solutions other than just waiting it out. And in some cases, some of those locations have actually recovered and started to grow again. But yeah, I think people who put all their investment eggs in the one property basket are asking for problems down the track.
Yeah, I guess that's the problem. We sort of did see that 12, 14 years ago, the mining town boom, and people, the frenzy, because it was like, it's too good to be true. I mean, doubled in value in 2 years, and I've got some ridiculous yield, and it's like heaps of people renting it. I'm going to go again, without fully understanding the risks associated with that, and what could go wrong, if that mine was to close or things were to change. Terry, thank you so much for coming along today. It's been a really interesting chat. Really appreciate your time. Appreciate your honesty there about the name of your business, and sometimes wondering whether you could have named it something different. And it's been really great to meet with you and have this discussion today.
Okay, no, it's been a pleasure to come on and have a chat to you. As you can probably tell, I do love talking about real estate investment and all the dynamics and what drives markets and how you decide the good places to buy, because I think that is the secret sauce. But it's not rocket science. It's really quite a simple process once you know how to do it.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.